This is Oliver Slope with Blue Line Futures coming to you from the floor of the CME here in Chicago, and we're seeing a little bit of a bloodbath here in the grain markets as we see some position squaring ahead of tomorrow's USDA report. But I think the bigger catalyst playing into this weakness here today is the fact that the U.S. and China will not resume trade talks next week. That is something that a lot of people were kind of looking forward to, and they're also are saying that we may not have anything concrete before March 1st. So a little bit of a negative tone, but you got to take that with a grain of salt. These negative headlines have often been combated with kind of a walk back or a positive spin, so I wouldn't be surprised to see that happen, but that's going to be kind of on the shelf. Tomorrow is the big day, finally getting some new numbers from the USDA. I wouldn't be surprised to see these markets work a little bit lower, but we're looking to be buyers on dips going into the weekend. So for corn right now, trading in a little bit of a range over the past couple months to stick in the mud as we await that new news. 375 is kind of the low end of the range, but wouldn't be surprised to see us work a little bit closer towards 370 if we get a bearish report. And as I had mentioned, we'd like to be buyers at this level. Now, as far as soybeans go, I think this USDA report is going to be a reminder that there is a lot of grain in the bins, and I think that will provide an opportunity for a break lower. $8.98 to $9 is significant support where we would likely be aggressive buyers. This pocket represents the 100-day moving average, a key retracement, the January lows, as well as trendline support from the September lows that we have tested and held several times over the past several months. So that's what we're looking at for corn and soybeans. Wrapping things up with the wheat market, kind of the same type of theme. We'd like to be a buyers on a dip. Yesterday we saw kind of a reversal off of highs, making new highs, but closing on the lows for that Chicago contract, set the tone for overnight weakness, and that spilled over into some profit taking here in the early morning, early afternoon trade, and now breaking down. 510 is a must-hold area for the Chicago contract. $5 for that Kansas City contract is going to be psychologically significant to wrap up the week. We think that Kansas City probably has a little bit more potential to the upside than Chicago, so we like being buyers, but again, kind of want to wait and see how the dust settles after tomorrow's report before getting overly aggressive. So that's what we're looking at. That's what you should be looking at too. This has been Oliver Slope with Blue Line Futures from the floor of the CME.